this is the whole price pattern that unfolded last year. You and I covered this several months ago. If you look at the SP 500, it topped out in June, July, put in a low right at the end of October, did this rally. So, I think we can have one big push into May, and then maybe that'll be the end of the blow off phase and we go into a multi-year correction, or maybe we just see a big pause. But a lot of things are in play for this year to probably end very, very ugly. I think we could see big rally followed by a massive sell-off that could kickstart a bear market that could bleed over into 2025.
Chris Vermeulen is back. He is the chief market strategist at thetechnicaltraders.com. Exactly how high can the markets go before a correction happens, if it happens at all? Let's discuss the technicals with Chris today. But first, a message from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space, along with unique tax benefits. No doubt you've had seen how high Bitcoin has climbed. So if you like to park your Bitcoin in a safe IRA, iTrust Capital may be the place for you. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on iTrust.capital/David in the link down below to learn more and get started. Chris, welcome back to the show. Good to see you.
Hey, thanks for having me, David. Always a pleasure.
S&P's reached new all-time highs. So have the other indices. My first question, do you still think we're going to get a correction, and why? I'll let you start there.
Yeah. So, I mean, I think the last time you and I talked a month or so, almost 2 months ago, I was talking about how we want to see the stock market hit new all-time highs and we want to see it keep pushing up. And to me, that is going to be one of the final straws that is going to probably kick the markets into a major top, and we'll see some selling later this year. And that's pretty much exactly what we're starting to see. If I was to just share my charts and we take a look at what the markets are doing, they're still playing out very similar to typical emotional trading in terms of, if we take a look at the last week and a half on the right-hand chart here, or sorry, the left-hand chart, this is the 30-minute chart of the SP 500 futures. This pink line is the 20-day moving average. And we keep seeing waves of panic selling. We see an oversold market condition. This is when everybody is betting on falling prices. They're expecting the market to keep falling, yet the market rallies. And eventually we get into a FOMO state where everybody starts to pile in right near the top. And then what happens is suddenly the market will have a big gap down. We go into an oversold condition. People panic out of the market. And just as they start getting out of their positions and betting against it, we start to see the market take off. And it really keeps putting the active trader, the emotional trader who's going from FOMO of missing out to scared and they don't want to hold on to losers. The market loves to buck those trends. And if we take a look at the weekly chart here, David, I've got the weekly chart of the SP 500 on the top. And this is a really interesting setup because we've seen this happen a couple of times. So more or less, the top chart is our weekly of the SP 500 telling us when we're in a bullish phase. It tells us when we are in a bearish phase. We are currently back into another bullish phase, and we've just broken to new all-time highs. And I've been talking about how we want to see new all-time highs on the SP 500. To me, that's the most important index. And what happens at this point is going to be very important. And what I like to see once we've hit these new all-time highs, because I do expect the market to have a major top this year and go into start a big correction at some point, as we tend to see everybody start to pile into the stock market. Anybody who is short is starting to cover their shorts. People who missed out on the huge rally last year are now saying, well, the market is in an uptrend. It's at all-time highs. I have to get in. They have FOMO that they're going to miss the next major move. And we're just starting to see that. And the Russell 2000 on the bottom shows a really good signature of this, where the Russell can channel sideways, and then suddenly the stock market starts to rally and break away, and people start to move into small caps a bit. They rally up a little bit more, and then suddenly the market crashes and we see a huge correction. Same type of thing happened over here. We saw the growth stocks, the average investor really piling in, and they really came into a halt here February, March of 2021. And small caps really just went into a sideways channel while the broad market kept moving up. And then suddenly there was one final little squeeze where everybody piled in to the small caps. And then we went into a huge correction. And that leads us to where we are today, which is another big consolidation. We're just starting to see small caps and growth stocks outperform. The ARK ETFs are doing very well. That's a good signature of what the short-term traders are doing. And of course, we are back up at all-time highs. And just a couple of days ago, when we saw this huge gap down and massive panic selling, that was a distribution selling day, meaning the institutions, now that the general public is starting to move back into the market because they feel like they're missing out, the institutions are starting to unload shares and dump them into the hands of the average investor because they see, I think, the music coming to an end. So, the big weekly chart I just showed you is very similar to this short-term chart. It's just two different time frames of the same thing kind of working out. But it's very interesting because we're starting to see those signs, those early signs that the stock market, I think, is about to run out of steam now that it's made these all-time highs.
All right, Chris, if you don't mind just zooming out and looking back to 2008, 2009, same chart, same index. My question is, look, the S&P retraces 2007 high in 2013. Back then, people could have made the same comment, which is that, well, look, it's retraced previous all-time highs. Maybe it's time for a pullback. And in fact, it didn't. As you know, it kept climbing until new highs basically this year. It was the longest bull. Well, actually, no, until 2020, the longest bull, 2021, the longest bull rally in pretty much American history.
Yep.
Right. What is different this time than the last decade-long bull rally is my question.
I don't know. I mean, everyone is always different. We're in a totally different type of economy.
Yeah.
Everything is totally different. Every wave that we have. Now, this is what really separates what I do from most others out there is, I follow the trends. I'm a technical trader. So while I think the market is topping and I think we see signs and I do feel like we're just ready for a big type of pullback, I mean, we're long this market. I mean, we are screaming higher. Our positions are up dramatically, and we are long this market. If the market just keeps rallying, just like it did in 2013 and keeps going for a couple more years, we're going to be long this market. Our long-term investing signals are still long. We're bullish. Our short-term strategies, we're still long. So, I do feel like we have gone through a major super cycle kind of bubble in terms of we've seen home prices just explode. We've seen stock prices explode. Everything has just been, squeezed higher into a bubble phase. And typically when everything is in a bubble and there's, interest rates are low, we usually go into a major super cycle. I believe we're going to be very similar to the 2001 market top, where this could actually take several years to slowly unwind. We might have very weak pricing for a long time. But I mean, we need to have the market prove that it's going to do that. But we are definitely in a bubble phase. I know, I believe we're already starting in a recession. But when you look at the recessionary numbers that the financial systems use, it doesn't really truly reflect where we are. You look at like overseas, they're already talking about they're in a recession, but they have different calculations for that. Whereas the numbers that we use in North America are all more or less fudged, and they take out all the things that are important, that are true inflationary. So I think we're very close to a big pullback, and we're similar to just everything being way too expensive, and businesses are starting to slow, and we're starting to see people get laid off. And I think it's just a slow burn. It's just that momentum is coming to a grinding halt, but people are still in kind of spending mode. People are still spending, but once they run out of money, or that all that spending kind of momentum stalls out, that's when things are going to dry up very, very quickly. And I know real estate pricing has already come down dramatically. There was a report out on Friday that the average home in Vancouver is down 25%. In Toronto, they're down 20%. In my town, we're down about 18%. So, there's already some big losses. People bought homes for $1 million, $1.5 million a year or two ago, and they're already down 200, 300 grand. But it's just so early that it hasn't really, I think, got a hold of everyone, and has started to create the worry to start slowing other people from spending. Just like COVID, the crash was so fast and the rebound was so fast, it didn't really get full hold of everything. And that's where we are. We're just starting a recession. Things are just starting to slow. We need more time for it to mature, and then for more people to get nervous. And it's a self-fulfilling thing. People start to tighten up, businesses tighten up. So I think it's a slow burn for these major cycles.
Chris, are you looking for technical indicators or fundamental indicators before you take some profits off your long position? Or are you mainly just waiting for either a target level or a significant pullback? And so you
Mhm.
want a correction to confirm that we're entering a new bear market. So what basically my question is, what are you waiting for to let you know that this correction is either already here or
Yeah.
coming?
Yeah. So for example, like here is our SPY chart on the left. This is our strategy chart. So we've already gone up and hit some of our targets. We're very close to a 15% target. And so we scale out as we hit these levels. And as we scale out, we put that money into a different ETF. Typically right now, we're putting it into bill. So we collect daily interest. We can squeeze an extra 30% out of the market safely. And then sometimes we end up reloading into the markets. For example, we also have half of our portfolio along the NASDAQ. We hit our 15% target. We closed it out. The market was ended up generating a new buy signal. We've already rallied up, hit our first target, and now we're just letting the NASDAQ and the indexes continue to mature. And what's really interesting is we're still seeing very similar type of sentiment moves in the market. When we look at this right-hand chart, this is my custom sentiment chart. And when we get these red bars, when we are in a strong uptrend, a bull market phase, when we get these red bars, this is when individual traders and investors are panicking. It means they're not only selling their positions, but a lot of them are actually betting against the market and they're buying inverse ETFs, they're buying put options. And what happens is when all these people hit this threshold, I'm able to analyze that and be like, okay, most of the people have now bailed who are going to bail, and then the market takes off without these people. They start betting on it to go down, it takes off. We saw this couple about a week and a half ago, 2 weeks ago, and we've already gone up and we're already hit a target and we're moving higher. So we're still in a strong bull market. We keep getting these little waves of small pullbacks that scare enough people out of the market that it resets and it keeps going. And so from a short-term basis, this chart here, this type of analysis, when the market rolls over 2, 3, 4%, we'll be moving out of it and moving into something else. Could be the US dollar ETF, which will go up as the stock market corrects. So this is a very sensitive kind of swing trading position strategy versus the one I showed you here, which is, let me just pull up just the SP 500. We could be in this still for several more months. And from a technical standpoint, we do need to see price trade down, correct far enough that it loses its momentum. The short-term trend turns down, the long-term trend, but everything is based on technical analysis, intermarket analysis of where money is flowing between different commodities, currencies, sectors even. And by using all those technicals of where that money is flowing, we can generate these bigger signals. So from a short-term standpoint, the other chart, we're long and we're more aggressive, we're active, so we don't hold during a drawdown. As an investor, if you're going to be kind of set it and forget it with bigger trends like this that can last a year or two, you do need to let it pull back. You do give back a good chunk of the gains because you do need to still give a major trend lots of room, breathing space to wiggle, and you don't want to get out until the trend is confirmed. So everything's still based on technicals, no fundamentals. I don't care what the Fed or the news or anything like that is. It's just we follow price and we want to know where the money is flowing, in or out. Is it a bullish flow or a bearish flow? So that's how I go about analyzing the markets from an investor or active investor standpoint.
You know, something interesting I found, Chris, is that the VIX index is up about 11% year to date. Meanwhile, the S&P 500, along with other stock market indices, are up. Now, typically, they don't move up in the same direction, at least for an extended period of time. Do you have an explanation as to why?
Well, if we take a look at the VIX here, this is the daily chart. And just as you mentioned, on average, if you look at these moving averages or this channel, higher highs, higher lows, that is an uptrend. Yeah, it's been moving up with the stock market. But as you know, David, the market climbs a wall of worry. People are getting more and more worried, and the market keeps going higher and higher. And eventually there'll be some breaking point where we're going to see people say, well, I got to get in on this. And we're probably going to see the VIX fall. We're going to see the stock market have one more big push and people get into the small caps and growth stocks. And that'll probably be like the blow off top in the stock market. So there could be still an explosive move, but this rising VIX and rising stock market is telling us, I mean, we've seen this over and over again. Here we had a rising VIX, and then eventually people realize that they just have to get in, and they all pile in, and the fear dissipates. We had it again over here. So, this typical price action, rising markets, rising VIX is simply people getting more and more nervous as it goes higher and higher. They're buying more and more leveraged inverse ETFs or put options until they hit the breaking point. Then they all have to cover, and then they decide to get long, and the VIX will fall. And it's just a kind of a repeating cycle. But this is just typical human kind of psychology of people worried about falling prices, and they're fighting the trend. And if you fight the trend, you're screwed. In the long run, you're going to give all your money back at some point. Could be next year, could be 10, 20 years from now. If you don't manage your positions, you don't follow price, you will eventually give it all back. And that's what a lot of people don't understand is I deal with a lot of traders and investors who have been doing this for 20, 30 plus years.
Right.
And they're like, my account has pretty much stayed the same for the last 20 years, or they'll go through massive roller coasters because they'll be on a winning streak. And then suddenly it only takes a couple bad trades or one big trend against them, and it wipes everything out. And that's because you don't have position management, risk management, and you're obviously fighting the trend, or you don't have a way to identify when the trend changes for you to get out and go find something else that's moving in a favor in a direction that you want.
Now, correct me if I'm wrong, but yeah, I agree with you. It just seems that it's a frothy rally if the VIX is also moving up with the markets. I mean, typically, let's say if you take a look at what happened in September 2023, for example, there was a huge correction in the markets. That's why the VIX spiked. But typically, when the VIX goes up, it means the market's already going down. They're contra indicators, right? So when there's more fear while there's a rally, it just doesn't seem like a healthy rally. How would you respond to that?
I think the market going up with fear is actually a very bullish sign.
Okay,
I tend to see we go into very strong rallies because it means eventually there's going to be a reset and the VIX is
I
going to
see.
fall. And as the VIX falls, that means the stock market is rising. So we just have to hit that tipping point where everybody finally, has to give up, and we suddenly see, people start to move in, cover their shorts, and that means the VIX will be falling. So the higher the VIX goes, like when the VIX is high, it's time to buy. That is the saying. When the VIX is high, usually means stocks are low or there's a lot of fear and people have been selling. And so there's only going to be really buyers left once that selling kind of dissipates. So when the VIX is high, like it is, it's actually a bullish sign. When the VIX is low, you want to go. And that means there's no fear and people will be buying call options and triple leveraged ETFs. And it'll be the exact opposite of what we're seeing right now. So I think a high VIX market at all-time highs is a recipe for further rally in the markets. And for a lot of people I think we could see a very strong surge in price. Could be a 4, 5, 8% rally in like the SP 500 or the NASDAQ here over the next month or two. And a good kind of scenario here is if we actually take a look at the seasonality chart of the SP 500, March is typically a very strong month. So is April. And then the saying is, sell in May and go away. This is the whole price pattern that unfolded last year. You and I covered this several months ago. If you look at the SP 500, it topped out in June, July, put in a low right at the end of October, did this rally. So, I think we can have one big push into May, and then maybe that'll be the end of the blow off phase and we go into a multi-year correction, or maybe we just see a big pause. But a lot of things are in play for this year to probably end very, very ugly. I think we could see big rally followed by a massive sell-off that could kickstart a bear market that could bleed over into 2025.
Interesting. Chris, let's take a look at gold. You mentioned gold to me offline. It's performed very well this year. Well, all throughout last year, but how is it holding up against a really strong equity market?
Yeah, gold's holding up really nicely. It's a very defensive play. We can see it's just kind of really channeling sideways with a bullish bias. It has a rally, a pullback, a big rally again, and is consolidating. This is a very strong chart pattern that is still pointing to higher pricing. And we are in a favorable time where we can see gold, silver, and miners perform very well. If they can get some traction here, they could actually rally very strongly into May, even with the stock market. The stock market will help lift it, I think, as well. But once we see the stock market get very close to a top, that's usually when we see gold, silver, and miners actually come to life and become the best asset during that market phase. It might only last a month or two, but overall, I do think we could still see one strong bounce and rally in the precious metals space as we go into May. And then after that, when there's panic selling in the stock market, it will pull all of these assets down. We saw that about 2 weeks ago with that big distribution selling day. Everything went down. Gold miners fell 6-7% on average. And so they're definitely not protective type of play when there's mass selling. And that's what a bear market is. It's never ending mass selling for months and months and months, and it'll pull everything down. So gold, I am bullish. I do think it could have a nice rally potentially, or hold its ground very well into May. And then we'll have to see how it goes. But you're right. It's got a very strong chart pattern. It's at support. Gold miners, silver miners are all oversold. They're down near, well, they kind of broke support, but they're oversold, ready for a bounce. So we'll see how that unfolds over the next month here.
Typically during a panic sell, Chris, what do you do? Do you stay on the sidelines and just stay in cash? Do you short? Do you dollar cost average? What's your play?
Yeah. So if we were to kind of go back and look at what happened in 2022, 2022 was the year for the US dollar. So we weren't really long equities, I think only a couple times for a few moves. The dollar really becomes that defensive play. Almost everything goes down but the dollar. And so we do move into UUP, which is a long US dollar index trade. I do believe the dollar is building a big base and launch pad here. I feel like the dollar will skyrocket again if we go into another major correction in the stock market. Another thing that we move into is bill. I mean, it's the most boring position you could ever do, and it's a really funky looking chart. But what this is a 1 to 3 month treasury note, a treasury bill, and more or less you just get paid daily interest. So if you bought it here, for example, and then sold it a couple of weeks later, you sell it out, you get the interest paid out to you as an increase in share value. If you hold it beyond the last day of the month, then you get it paid out in a dividend, which is giving income at a lower tax bracket. And so really you just hold it, and as long as you hold it, you just keep getting these dividend payments every month. And you don't earn a ton. You get just over about 1/3% a month. But when the stock market's falling 3, 5, 10% a month, and you can sit here and watch your account go up, it is a pretty priceless, incredible feeling knowing that every day we're making a couple cents on our position. It's going up, and we don't have to really worry about something. So, we're always looking to a different asset class. If stocks are crashing, we go to a totally different asset that's going up or that holds its value and pays us dividend. Now, the one thing that we do is if we enter a bear market, a stage 4 decline, as you and I have talked about in the past, just like the 2008 bear market, the 2000 tech bubble, that was another stage 4. We will trade inverse ETFs on the index. So we can profit from the collapsing price on average. So we do that, but it's very rare. There's only a few of those trade setups during a bear market, but we do take advantage of it. But then we're a long ways away from that. A lot of damage has to be done to the charts before we're actually in a technical stage 4 decline, a bear market.
Okay. So let's finish off on gold, and then we'll move on to another asset class. So
Sure.
you talked about how the gold miners have underperformed as well. When you're looking at the gold miners, Chris, one of two things come to mind. Either you're playing this as a leverage play on the spot price of gold, or you're playing this as a leverage play on the Russell 2000 or perhaps mid cap stocks. Well, which philosophy do you take?
The way I've played gold miners is I look at it as a leverage play around the precious metals, around gold or silver. So when I see gold and silver, in a raging bull market, starting something major, and the gold miners are taking part, which they're not right now, that's when I want to jump into gold miners. To me, they're just like they're almost like buying a call option on the precious metal space. These things move fast. You can get ones that pay dividends. You can trade just an ETF like GDX or GDXJ or whatever you want. To me, they're just a leveraged way to take advantage of a pocket of commodities, which is gold, silver, and jump in. And these things can rally hundreds of percent, which is pretty incredible. But you need the perfect storm to align, and it takes years to unfold. And I believe we're getting very close. Maybe this year, maybe next year will be the year for a massive rally where this space becomes the hottest thing, since 2008, 2009, when it really took off and started the last major run. But yeah, to me, it's just a leverage play around gold and silver pricing.
Okay. I just have to point out that the gold miners, um, so if you go back to 2008, where we had that big market correction post Lehman crisis, great financial crisis, gold went down momentarily, but then recovered shortly after. The gold stocks, if the GDX followed that pattern, but it really didn't do well. So I think my question is, Chris, when you do have a big market correction, is it that everything goes down together at the same time? And so the only safe places are the places that you've mentioned previously. And it really doesn't matter if you're in gold or gold miners, both are going to go down during a flash crash.
Yeah, everything will completely crash. We generally have to move to a different asset, either benefit from falling prices, meaning bet against the market, so you want it to fall,
Yeah.
or you need to move into a different asset class. The dollar tends to do well, but it doesn't always go up. There's the UDN, which is an inverse dollar index play. We've traded that. So it really doesn't matter which way the US dollar is going. It gives us a low volatility move into a different asset class that generally currencies trend very nicely. We can move into these slow moving plays while the rest of the markets are falling apart. But yeah, when we go into a crash, flash crash, or multi-year bear market, gold, silver miners, pretty much every sector pretty much just crashes. And I was talking to somebody over the weekend who's not into investing. They just got into investing and started to buy a bunch of stocks, and a lot of them are small cap stocks. Very excited, and that is kind of like one of the final straws when people who don't know the space are moving in because everything's been moving up, and they're buying into Nvidia and they're buying into all these kind of high flyers that pretty much have already made their massive runs. That's a big red flag that the last of the people who aren't in the market yet are just kind of getting sucked in right now. And unfortunately, this is a cycle that repeats. The masses end up holding the bag of tons of stocks. They usually enter near the top and then they hold it for a long time, years, in big drawdowns, and have to wait for it to come back.
Will you ever have to make a choice between the equities and gold? For example, let's say, could you envision a scenario in which the equity markets overall start dropping or
Mhm.
start a slow decline, but gold holds steady and perhaps even climbs? Under that circumstance, what do you expect the gold miners to do? Perform like gold and hold steady, or perhaps fall with the rest of the equity indices?
I mean, if gold is trending up, I'd be moving into gold. Like once gold starts the next major run, I'm going to be very interested to get into more physical gold. I'd be interested to get into gold miners. I always have a pocket of money that I want to delegate just to those.
Yeah.
But generally, I'm always going to have the core money based around my index, my bonds, my currency, and my that bill treasury note. Those are the four different asset classes that I find you can rotate in and out of very safely. But when there's a new super cycle starting in something, when the next one starts, I will take a chunk of that money and I'll aggressively trade it with that new super cycle in gold, silver, in miners. But I won't just completely abandon the stock market and other things just because something's hot. I always like to just get involved in something that's super hot, but stick with my money, my core money, with my major strategies that are very liquid, slower moving, safer kind of investments.
If you were to enter well, if we were to enter a bull rally, wouldn't you want to allocate capital into um, riskier high beta equities that isn't gold related? In other words, would you play gold stocks like a safe haven trade, um, meaning you would go in when things are getting tough or when gold is doing well, but not necessarily when things are doing very well, in which case you probably want to be long the tech stocks or something like that, right?
Yeah, it really depends on how they move. For example, if we were to take a look at GDX, and on the bottom of this chart, let me see if I can pull it up. This chart may not go back far enough here. Um, there's scenarios here where, just see if I can pull up a really good scenario. So the bottom of this chart has got red bars and green bars. Green bars is when the stock market is favorable. and red bars means you don't want to own stocks. So the bottom
Okay.
strategy is based on what we should be doing with the overall index. And let me just zoom in a little bit here. Um, this is the problem with precious metals is the miners. They're a very big wild card. They carry, to me, they carry almost more risk than anything else because they can move 5 to 10% a day, the ETFs alone. So the individual stocks can move a lot more. But if you look at the bottom, when it goes from red to green, this is when we want to move into the stock market. We want to hold stocks. Well, gold miners pretty much go down. And even when the stock market has been favorable for a very long time, a couple small bouts of selling, it really just still treaded water. And then suddenly the stock market gave a sell signal. We wanted to move out of stocks, and then gold miners took off. And eventually there was another sell signal in the market. Stock market collapsed, yet and gold stocks sold off with it. So they move with the market sometimes and without, and you never know when they're going to flip and switch gears. And this is why a lot of people lose a ton of money on precious metals, is because they have this random card. They sometimes move with the market and then sometimes do the exact opposite. And the market is hard enough to trade and make money on your own, but when you throw in a wild card where it could just flip a switch and decide to go the opposite, as it has been for the last couple of months, it really can cost you a lot of money. And that's why I don't want to touch miners until there is like major momentum and confirmation that gold, silver are in an uptrend, gold miners are in an uptrend, and it's showing strong signs, because then they'll just rip higher. But this is the biggest risk, is it flips with or against the market at any given time. And that is what a lot of people don't understand, is they're very random, and random is not easy to make money from unless you are really good with position and risk management.
I see. How do you feel about the US dollar right now? DXY. Can we pull up a chart? The
Sure. Yeah. I
dollar
like the dollar.
yeah.
If we take a look and zoom out here a little bit, we can see it's been building what looks to be a rounding base. It's gained quite a bit of traction. I do feel like we're going to see this skyrocket up to 116, maybe even up to the 120 mark sometime this year. So I think it's going to be a very strong move, a lot like we saw in 2022. I think the stock market is going to put in a top, and we're going to see the dollar take off. And we can use actually Fibonacci extension, which is one of my favorite tools, and I find it's the most accurate. This tells us what the upside momentum and the upside targets should be. And if we just look at the dollar, you can see it has got potential from where it is right now to rally roughly almost 20%. For a currency, that is a huge move. And the 618 extension happens to be the previous top. And to me, this is like the perfect setup. The market will rally up and it'll pause and pull back a little bit. And it'll do that for two reasons. 618 is where the momentum should run out temporarily after this move. It's also a previous high. And if I have found that if the market pauses and pulls back at the 618, we almost always go up to hit that 100% measured move. So to me, the dollar is set up for a very, very strong move, which means we're going to see metals move down. We're going to see the stock market will be crashing. Everybody right now is super bullish and thinking everything's still good. But I don't believe that's the case. I think things are crumbling under the scenes. The dollar is built a base ready to go higher. All these things, like these basing patterns in the dollar where they carve out these rounding bottoms, usually means we're going to see some type of big rally. And that means it's economic weakness, stock market weakness, all those things.
Right. Okay. Chris, what else do you like? Any sectors, asset classes you really like besides what we talked about so far?
I Not really. I mean, if we take a look at XLP, which is consumer staples, it's a slow moving sector. I'm not a fan of the fast moving sectors right now, the growth stocks. But if we look at XLP, which is super basic, we're talking consumer staples, toilet paper, toothbrush, has a nice steady uptrend. This usually does well during when the market is fearful. As you mentioned before, we've been seeing the VIX move higher. And when people are nervous, they move to defensive sectors like utility stocks, generally, consumer staples, because no matter what happens, if the stock market crashes, people still need the basic staple products. And so I think we're in this environment where we're seeing fear climb, and people keep kind of moving into this, and it is pointing to higher pricing. It's a very slow conservative play. It's nothing like, blockchain ETF or these semiconductors or the ARK ETFs, but it's not always about how much money you can make. It's about how much can you make safely, and if it doesn't work out, how much money can you retain and move out of that position before getting hit. And so we're in that environment where we need to be very cautious. I like the slower moving things right now because I believe we're just walking on thin ice here for this market.
Well, Chris, thanks very much. Where can we learn more about you and your work?
Sure. If anybody wants to see what I do, go to the technicaltraders.com, and I run through the charts just like what you and I do. And I share all my trades that I put on with my own capital. I trade ETFs only, but I cover all the different spaces. I cover precious metals, miners, all that stuff. So if you're looking for swing trading, kind of a position trading strategy to manage your capital and have 2-3 times the returns with a lot less volatility, that strategy is what I focus on. It's all about preserving capital. If you cut your losses, you don't have to worry about the gains. They just naturally keep stacking up, kind of one second base hit at a time. And that's what I focus on.
Great. All right. Thanks, Chris. We'll put the links down below. Make sure to follow Chris, the link in the description, and we'll see you next time. Thanks, Chris.
Thanks, David.